Good evening, everybody. How are you? My name's Andrew Coronis, and I'm the Managing Director of the Coronis Group. And I wanted to extend a warm welcome to the hundreds of people who are here tonight to listen to myself and Tyson James, Jodie Ford, and Trent Wilshire from Domain about the state of the property market in Queensland, especially, more particularly, about an update for the financial year, the end of the financial year. Again, thank you so much for tuning in. It's our privilege and pleasure to be able to talk to you. The format will be that I'll introduce you to the topics. Jodie Ford will talk about property management. Tyson James will talk about the financial markets and more particularly mortgages. And Trent will talk originally about the state of the play on a national level. So I'll give you some insight into the market. Quite frankly, you know, one thing that we do know with COVID, and this is not trying to be something that's not specific, but I know one thing, that not many people do know what's going to happen. We have theories, we have ideas what's going to go on, and we're going to share those with you tonight. It's going to be very in-depth, and you can make up your own decision. We'll also have at the end, after about 20 minutes of us talking, we'll have the ability for you to ask questions online. So please, if you have any questions at all, we're here to answer. It's casual. It's supposed to be something very informative for yourself. It's not meant to be too structured so that you get something from it. So if you have any questions, it would be great if you could ask them online and we'll answer those for you. So look, in particularly for me, I'm really proud to introduce you to one of the head economists at Domain, the big property portal, as most of you know, and they have a very good insights into the data and what's happening in the market in general. And Trent Wilshire is one of the heads of the economic section down there, and he's going to have a talk to you now for the next 5 to 10 minutes, or maybe a little bit more. If you have any specific questions for Trent, please send it through as he's talking, and we can ask him when he's finished talking. So I'd like to give you to give him a warm welcome, digitally, of course, and a very warm COVID welcome to Trent Wilshire from Domain. Trent, over to you, buddy.
Thanks very much, Andrew. Thanks for the introduction. So yeah, I've got sort of about 10 minutes tonight just to run through how I'm seeing the market and the economy overall and what impact it'll have on the Southeast Queensland market. So I'm just going to structure my little presentation like this. So just running through what the sort of immediate impacts of COVID-19 were on the market and the economy as well. What's happened recently, what are some of the recent indicators we're seeing about how things have changed, and then looking forward, what I'm expecting to happen to the economy and to the market in the future. So just to start with the immediate impacts of COVID-19, we know that the market changed, everything changed dramatically come sort of mid-March. And we saw in terms of people's activity and people's searches on Domain as well, that people really changed their behaviour from pretty much mid-March. That was even quite well before the government actually introduced their lockdown laws and things really started shutting down. So people really changed their behaviour. So that means Google Maps transit data, restaurant bookings, and on Domain as well. So really property dropped out of people's minds from mid-March onwards, and we saw a really big reduction in activity on Domain. In terms of the impact on the economy, the ABS the Australian Bureau of Statistics ran a survey to gauge how big the impact was on businesses. So they found that 2/3 of businesses were impacted negatively by COVID, and 2/3 actually, more than 2/3 expected this impact to affect them have an impact in 2 months' time. So a very widespread impact. It wasn't restricted just to some sectors. And unfortunately, that flowed through to the labour market, and lots of people unfortunately lost their jobs, had hours cut, incomes were reduced. So the best data, again, from the ABS, so between the 14th of March and the 2nd of May, overall in Australia, the number of jobs declined by 7.3%. In Queensland, number of jobs fell by just over 6%. So significant job falls in such a short period of time. But actually a lot of especially tourist areas were hit a lot harder. So job numbers fell by 9% on the Gold Coast, 10% in the Sunshine Coast, and 9% in Cairns. So even more significant than the national fall and the fall across Queensland. And of course, the most significant falls were in the industries like tourism, hospitality, and arts and recreation. So what did those big impacts mean for property searches? So we saw listing views on Domain drop by 1/3 between the end of Feb and the end of March. So quite a significant drop off. But actually the low point in terms of people's engagement with property was actually at the end of March. So people started searching and it rose quite rapidly through April. in terms of what vendors, people looking to sell their properties were doing, so we saw a significant drop off in the number of new listings from mid to late March. And not surprising, vendors like to sell when the market's much stronger. So you know, the amount of new stock coming to the market fell away quite significantly. One good thing though we have seen is there hasn't been a big rise in the number of forced or urgent sales. That's a sign that government support packages have done their job and people haven't needed to sell their house. The other big thing we saw was in the rental market. So we saw the rental vacancy rates, the number of vacant properties rose dramatically in April. That was because demand for rentals fell as people moved back home, dissolved share houses, tried to save money. And also Airbnbs were put onto the long-term rental market. So the supply of rental properties increased quite a lot. That meant there's been downward pressure on rents. So on to the second part, what's happened recently. So overall, it's really a good news story in terms of the economic outlook and how the economy has performed relative to what was expected. So you look back in sort of early April times and things looked really dire. It looked like we're heading for a deep and prolonged recession. But really, we've had a deep recession, but it's looking like it could be quite short, which is a really good sign. So the shutdowns, border closures, people's responses to COVID have been effective in slowing the virus, and that's given the economy the best chance to grow again over an extended period of time. So some of the good signs are that consumer confidence has bounced back. It's back to almost pre-COVID levels, which is a bit below sort of average levels, but still quite a strong bounce back over the past few weeks. Business confidence has also rebounded quite significantly. Again, it's a bit lower than it was pre-COVID, but trending upwards. In terms of jobs, job advertisements, they've started to rise again, but that again comes after a big fall, but heading in the right direction. And we're seeing that in terms of buyer confidence in the property market as well. So looking at an index of the Westpac asked people, is it a good time to buy a dwelling? That fell away quite dramatically in April, but it's bounced back in May and June, and it's now again sitting just below where it was pre-COVID. They also asked what people expect to happen to house prices. Again, that fell away dramatically in April, but it's rebounded a bit too. So that sort of says people are out there thinking about buying property again. Maybe not urgently, but also it's in the back of their minds, and people with secure jobs might be more interested in looking to buy. So as I mentioned, we saw a big jump in people engaging, looking at properties on Domain from the last week of March. So we've had May compared to March, we had a 64% jump in the number of people looking at sale listings. In terms of prices, actually not really much impact on prices. So across Brisbane and Southeast Queensland, prices have been pretty flat. We've seen a rise in the number of properties being discounted, but really the big impact of COVID so far has been on transaction volume. So they really fell away quite dramatically. So both buyers and sellers withdrew. People were obviously worried about jobs. Incomes had fallen. Vendors were reluctant to sell as well. So it's really been an impact on volumes rather than prices, which have held up reasonably well. Just in the past few weeks, we've seen sellers become more active. So new listings in Brisbane are up by 37% over the past 4 weeks compared to the previous 4 weeks. But that's still below where it was a year ago. And the other one is the rental market. So Brisbane's rental market has stabilised, but it does remain a tenant's market. So the previous month's trend of vacancy rate rising dramatically has fallen. It's reversed with the vacancy rate falling partially back in May. And we've seen fewer rental listings being discounted in May as well. So the rental market has stabilised, but again, remains a tenant's market for the moment, but trending towards more normality. So what can we expect in the future? So it's really, as I said, I think we've done very well in terms of containing the virus, and that's given us the best chance in terms of our economic recovery. So I was very pessimistic in April, but I'm now much more optimistic about where the economy is heading. Obviously, still activity is going to be sluggish for a while. Unemployment is going to be elevated for a while. But again, much better. The outlook is much better than it was not long ago. The OECD, which is a big organisation of developed advanced economies, they put out a report last night saying Australia is really the best, looks like it's going to be one of the best performed economies over the next year or so. Australian Treasury put out a statement the other day saying they revised down their unemployment rate forecast. They expected the unemployment rate to peak at about 10% in June, but they now expect that to only peak at about 8% and possibly lower. So good signs there as well. So as I just ran through before, lots of much more positive signs. So what does this mean for property? So clearly there's more buyer interest out there. We've seen that through a number of indicators. I think we'll see activity start to pick up, but slowly. We haven't seen the big fall in prices as well. So looks like prices are going to only fall by maybe the sort of 5% range, which is sort of the lower end of a lot of price forecasts that were made not long ago. So that's the most likely outlook at this stage. Of course, a big factor there is what the Reserve Bank has done. So they've cut rates a number of times. The cash rate's down to its lowest level possible of 0.25%, and that's flowed through to mortgage rates. So fixed mortgage rates particularly, they've fallen quite dramatically. They're down to the low 2% range for a lot of borrowers. Variable rates in the mid to high 2% range for many people. Investor rates down to the low 3s. So really low interest rates will encourage people back into the property market once sort of confidence returns and once we know we're out of the sort of the depths of COVID. One thing that is a risk is what's been called the cliff in September, when JobKeeper ends and when mortgage deferrals that banks had offered are also ending. So that is a risk, but I really can't see the government withdrawing all support so dramatically. I think JobKeeper will sort of be wound or tightened a bit over the next few months, but it will be extended for sectors of the economy that are most at risk. And just finally, probably the biggest risk in terms of the recovery is another virus outbreak. So a second outbreak leading to another shutdown, I think will really hurt consumer and business confidence. Whether people abide by the rules, whether it's possible to actually shut down the economy again later this year, that will be a real challenge if COVID does spread in certain areas, if state borders have to be closed again. That's the real risk. So the real challenge for policymakers, and this will flow through the property market, is whether we can continue to reopen the economy. You know, sports crowds are returning probably next weekend in Queensland. New South Wales have got some this weekend. So, you know, events are reopening. The challenge will be to keep the virus in check. So I'll leave it there, but happy to take questions later on.
Thank you, Trent. That was very good. Really appreciate it. And you'll be here later on to have a talk. So I'm going to introduce you now to Tyson James. Tyson runs our financial services department, effectively mortgages and mortgage and finance section, and he's very knowledgeable in all things finance. So I'd like you to welcome Tyson James to the screen. Thank you.
Good evening, everyone. Thank you for joining us. Thank you for some great insights there, Trent. Few crossovers, and I'll try and relate back to Trent's points that he's made there, giving you some, I guess, correlations to what we're seeing, not only day to day, week to week, month to month trends with our home loan applications, settlements, and most importantly, I guess for our landlords, what does that mean for your investments? So just a bit of a disclaimer there, fine print, basically. Please discuss any of the information. It's general, okay? It's not specific to your needs. And if you'd like to have a chat with one of our brokers further, we're more than happy to do that. And we'll actually send you out an invitation after this to book some time and have a conversation to see whether we can help you further. I'd like to refer back to a report that came from the ACCC when they were looking into the mortgage industry and the banks. They were doing a lot of research into the competitive nature of the industry and why people who had home loans for 4 to 5 years were paying significantly more than people that were coming to the market currently. And what it actually found was that there was a 40 basis points difference between people that were getting home loans now and people that had home loans from 5 years ago. So we're sort of seeing that downward trend of interest rates, but what we're not seeing is consumers taking advantage of those new low rates. And I guess one of the big things that we're seeing is that lender loyalty really costing the consumer. We call it a bit of home loan complacency. And I think in a market where we're seeing high rebates in terms of banks paying you cashbacks and interest rates dropping, as Trent said, now is the time to be making sure that, I guess, your lending is working for you and not for the lender. As I referred, this is all really driven by the banks advertising new low rates to drive stimulus in in new applications. They make money when they lend money. So we see a lot of, dropping interest rates at the moment compared to where people's rates currently sit. And the report in September really highlighted that from September to March, there was a 26-point difference. And what does that actually mean for you? So if you're a client that hasn't reviewed your lending or made any adjustments over the last 5 years, or perhaps even the last 18 months, given the rapid drop in interest rates, you could be costing yourself over $1,700 a year on a $400,000 mortgage based on those variances. So I'd really encourage you now, whilst we're seeing valuations holding up on our current refinances that we're helping our investors and homeowners with, to take advantage of that, stabilisation of the market, to get the ball rolling, to reduce your repayments, maybe even take advantage of a cash rebate to really prop up your own personal position, but also make sure that your cash flow is working for you. Especially if we start to see a return of listing numbers to the market, there'll be plenty of opportunities to be able to strike. Trent also mentioned the high volume of activity leading into the year. And around March, we saw 26,000 loans valued at around $11.5 billion refinanced. So I think one of the things that we're seeing is we've seen the market really starting to take advantage and was really starting to get poised and get ready to gear up portfolios and purchase more properties. We were seeing more first home buyers coming to the market with the incentives that have been offered by the government with the first homeowners scheme, where they were offering to remove effectively lenders' mortgage insurance, saving a lot of first home buyers a lot of money on top of all the other incentives with first homeowner grants and capital gains tax exemptions. So we're starting to see a real run on the market. And in March, we actually had one of our best lodgement months we'd ever seen. What does it look like year on year in terms of our volumes of lending, and why is this important? I think if you have a look around the March, you can see the blue line starting to spike over the average, okay? That highlights all of that activity that Trent was referring to, as well as the high number of pre-approvals and applications we were actually processing in our team. We can see there that it fell away as expected, but year on year, we're actually up about 12.2% on our mortgage activity. So it's a very active mortgage market. People are taking advantage of the rates, refinancing their home loans, and we're still actually seeing a large number of first home buyers coming to market actually, as investors have sidestepped the market a little bit, playing on the sidelines. First home buyers are striking. You can see here that refinances have really dominated the marketplace. Low interest rates, high rebates. We're seeing up to $4,000 in some instances for people to refinance their homes. So it's no surprise that it's up nearly 41.5% year on year. But what's really encouraging is we can see that year on year purchases are still holding firm, up 24.1%, okay? We can see that the week on week, every time this report comes through, it's encouraging to see that the week on week variance is contracting. So we're getting more and more stimulus as the weeks go on, which is, I guess, reflected in the consumer confidence that we're seeing in the market at the moment. I did a little bit of research before jumping on, and I want to give a bit of insight. I'm assuming that a lot of people online aren't just investors, but they own their own homes and potentially have loans on those as well. This is just an example of 5 lenders that are offering rebates at the moment, and they vary anywhere from $2,000 all the way through to $4,000. we have some great incentives at the moment for frontline workers. One of our lenders has come out and offered an extra $1,000 bonus on top of their standard rebate as, I guess, a bit of a thank you to all those frontline workers that stepped up through these period to give back. So there's really, I mean, you probably won't see a better opportunity to get paid to refinance, really. We're seeing low rates, so it's not like the rebate is hidden in high rates. You can see there that the basic home loan package there from St George is around 2.64%, very competitive. What I do urge though is you can also see that we put in there the expiry dates or the must be lodged by dates. So these incentives will start to wrap up. Banks can't afford to have historically low rates and pay rebates. It doesn't make sense. So we will likely start to see all the rebates in the marketplace contract. So if you'd like to take advantage of that, it is something you should act on sooner rather than later. I also jumped in and had a look at 4 really good rates, I guess, around our investors and where you should be sitting at. And it might be as simple as either negotiating with your own lender to get your own rate down, or perhaps engaging one of our mortgage brokers or a mortgage broker to go and do that on your behalf. One of the really cool things about working with a broker is when the broker says to the bank, we want you to review the home loan rate, they know we're serious because it's easy for us to transfer the home to another lender to get you a great rate. When you do it yourself, sometimes they play on your complacency and you might not get the best deal possible. So if you'd like to leverage that, please reach out. We're more than happy to help you through that process. You can see there that a 2-year fixed rate, it is an introductory rate, but it's as low as 2.34%, okay, on a principal and interest loan. Now, that's very sharp, very exciting. I think to see interest rates at 3.08, I would not have thought we'd be here 24 months ago. I'd like to hand over to Jody. I'll be sticking around, so if you've got any questions, please feel free to pop them in the chat window. We're collating them and we'd love to answer them later on. I'll hand over to Jody Ford, our Property Management Director.
Thanks, Tyson. And thank you everyone for listening to us tonight. I think it's great for us to take the time out and review the market, and we do this on a regular basis, not just through the COVID period, but it's really important to us to know on a day-to-day basis and a month-to-month basis how the market is going overall. And I see my job as the Property Management Director at Coronis to find ways to make sure that we're getting the most out of the market. So you will find in some of the things that I report tonight that they will be a little bit different to what Trent has said. And the differences in there are around our strategies, I guess, for making sure we make the most out of the market. And one of those big things for us was around vacancy for landlords, and our vacancy rate, as you'll see when I talk a little bit further, is significantly less than what is being reported in the general market, and also what is being reported by some of the other agents. But our purpose very early on was to make sure we knew there was going to be still tenants in the market. So our focus was on making sure that those tenants were renting our properties as quickly as possible. And that's in effect what has made the differences there. So initially for the June quarter, we wanted to review the impact of COVID-19 and how the initial impact took effect for us. And what happened there was that we decided that there was 3 key things that we needed to do for our owners and for our tenants to make sure that we were ahead of everything that was happening. And the very first thing that we made sure that we did very clearly was communicate and educate. So that was educating our landlords and our tenants, also educating our property managers to make sure that they were able to answer all the questions that were going to arise. And we needed to know how all the stimulus packages, everything that was available to landlords and tenants, to make sure that they were accessing those things so that they were in a much better position for tenants to honour their tenancy agreements, to pay their rents, and more importantly, to stay in their homes. And it was really important to us to make sure in the early stages and all the way through that we were actually helping the people who needed to be helped. And sometimes that was the landlords and sometimes that was the tenants. But we we did see initially in that March-April period that there was a significant amount of people with our size rent roll. You can see the impact there of people who literally just panicked. And so were inundated by people who were wanting reductions in their rent. And in many, many cases, or in the vast majority of cases, they hadn't been affected at all by COVID at that point in time. So we had to work out a strategy where we were doing a means test there so we could eliminate the people who weren't in immediate need to start off with, so that we could really focus and concentrate on helping the people who were impacted immediately. So we provided as much information as possible to all parties and educated our property managers and landlords. So what the implications could be moving forward, and what the actual implications were at that immediate time, what assistance was available, as I said, so that we could start to get people onto those packages. So the second point, or the second strategy for us, was around assessment and implementation. And so we realised that we had to do a lot of things really differently, really, really quickly. And we made systems around that straight away. So we knew that we were helping people. We wanted to discourage people that didn't need things. And then we really wanted to get into the trenches with the people who did need help. And what we meant by that was not just, referring them off to different areas. We really wanted to sit down and with them, understand what they needed, and really research and find out as much information for their individual needs so that we could help them personally. Working hand in hand with our landlords and our tenants to help them. And then the third strategy point was around a laser focus on what we could do to help our landlords and our tenants. And if that for us meant focusing on leasing, working 7 days a week till 7 o'clock at night. So any tenants that we knew instantly that tenants were not going to be taking time off work to go and look at rental properties. And where other agents might have just been opening still 9 to 5 or 8:30 till 5, we thought, no, we're going to capture these tenants to get them into our landlords' properties, and we're just going to go out and show them through properties whenever they needed us to be there. And 9 times out of 10, it wasn't between 8:30 and 5 o'clock. So with that, what we did was make sure that our vacancy was as low as possible. And that's always a focus of ours anyway, but there was an extended focus around that. And assisting tenants in any way possible so that they could honour the payments of their rents and stay in their home. That absolutely was the priority for us. So as a result of implementing those 3 strategies very early on, we found that we had an uplift in our customer satisfaction. So we were constantly getting responses from landlords, responses from tenants, just really appreciating the fact that we were wanting to help them and getting in the trenches with them. And that meant in an industry average of a customer service or NPS satisfaction score, the real estate industry as a whole has been somewhere around that -41. And we're finding ourselves even now at that positive 59.5 at the moment, and it's been fairly steadily around that 55 to 60 mark, which really meant to us that we were hitting the mark. We were doing what landlords needed, and we were doing what tenants needed. Now, I think there's always variances with that, because there might have been some frustration about us getting too much information out there, but the reality was that we needed to help as many people as possible. The vacancy factor, now I've seen vacancies reported somewhere between, anywhere between 2% and 5%. And it's very hard to get an absolute gauge on those things, because in some instances the 5% are including markets in New South Wales that might have had greater impact. But the reality is in doing what we did meant that our vacancy factor got down to around the 0.7%. It was lower than that at some points through COVID, but it's still standing fairly strong at 0.7%, which is exceptional and very, very important for our landlords. And it also meant that we had less than 3% of our tenants needing reductions or deferrals, and as a result of us being able to get them help elsewhere. So in our communities, I just wanted to give you a little bit of information about which areas have been impacted more than others. And because we've got a unique position where we are managing properties over a vast area, I wanted to drill down a little bit into some of those suburbs. So we've looked really closely at the Gold Coast. Now, the impact there was fairly significant to begin with, and we did have on both coasts, Sunshine Coast and Gold Coast, we had a lot of tenants approach us from those areas who had lost their jobs. There was a lot of hospitality workers in those areas, a lot of holiday workers in those areas, and obviously there was going to be an impact for those people very early on. But now we're seeing on the Gold Coast, we've actually got zero vacancy on the Gold Coast, which actually means that we are renting the majority of our properties before they become vacant. And we're in the early stages, we did have to reduce some rents in order to get the tenants into the properties. That's really stabilised over this last month, and we're not needing to do that at all at the moment. So we're renting properties very quickly, lots of attendees in those areas, and it seems to be really holding strong on the Gold Coast and also on the Sunshine Coast at the moment. So on the Sunshine Coast, there's a little bit less properties available, there's less people moving around, but the vacancy there, we're always having people wanting to go and have a look at the properties, and they're renting very quickly on the Sunshine Coast as well. Now, for North Brisbane, the outer suburbs and inner suburbs, we've had less properties come to market for rent. We're finding that some stability and some comfort through that time was important to tenants, and they wanted to stay in the homes that they were in. But now we are having a very high demand and high attendance at properties, which is great for the northern suburbs. The majority of properties there have been renting before they become vacant as well. So in the inner city, this is a little bit of a different dynamic there. And I find that there's a couple of different reasons for that. So there's a large concentration in those areas of high-priced properties, and there were a lot of tenants that were affected in that high-end market. So we found, and also international students in those areas as well, in Toowong and Kelvin Grove and the inner city suburbs. So in those areas, we have definitely noticed a greater impact than other areas in our portfolios. But the executive market has really struggled, anything over 800, where people are thinking more practically about, you know, where they want to spend their money, and do they need to be spending $800 a week or $1,000 or $1,500 a week for a rental property. And we've noticed that a lot of that has come back, the demand for that has come back. And so in those areas, we are still noticing a little bit of an impact there, but the demand is still relatively good, and our vacancy is still sitting somewhere around about that 0.8% in that area. So when we go in a city or in a south, we're looking at properties that are renting really well through Coorparoo and Bayside. The rents are remaining really steady there, and there has been an increase of tenants breaking their lease in those areas. So again, it's that concentration of making sure if a tenant's breaking their lease, if they're moving out of the property, you know, what are we actively doing to capture the tenants to move into our landlords' properties. And then when it comes to the outer south areas, Forest Lakes, Springfield Lakes area, there's very low vacancies in those areas. Springwood even, we found, interestingly enough, over this last 3 months, in our Springwood area, we're actually noticing that there's lower vacancies than what we've had at other times of the year, which is, you know, certainly not what we were expecting at that point in time. So overall, from my perspective for the rental market, I think that, you know, the strategies that we put in place to make sure that we were capturing tenants, getting properties rented, being very active around getting assistance for tenants, also being very active around making sure that our arrears were monitored. It's one of those things that, you know, when you're talking to tenants and you're helping them to find ways to pay their rent, you know, we didn't have that massive influx in arrears. I do also have some concerns when we get to September, because I do think that, you know, we really need to be having strategies around what's going to happen there as the stimulus packages start to subside. But, you know, we will always, I also am a firm believer that we will not just cut that out. I do think that there will be a lot of work going to making sure that there's not people left out and homeless at that point of time. So thank you everybody for listening to the review, and I'll put you back to Andrew Coronis.
Thank you very much, Jody. Thank you, everybody. I've got the responsibility of talking about sales, something that's dear to my heart in Southeast Queensland. And I want to, I suppose, echo Trent's sentiments and Tyson's and Jody's. It's pretty much steady as it goes. We found that that is for house values. And I presume a lot of you are understanding or trying to understand, what's my house value going to do? Should I buy a property now? Should I wait for a property? What's going to happen to my rents in the future? What's going to happen to demand? These are all the questions that I said originally that really nobody can put a finger on at the moment, but we can give some insight into the trends, what might happen. And this will go back to what Trent said. But look, ostensibly, property is like every other market. It's a supply and demand driven market. Yeah, we are going to hit some headwinds, I believe, and this is my personal opinion, come September when JobKeeper finishes or the stimulus finishes. And that will determine on the government. As Trent said, he believes the stimulus will keep going on from September. We're in pretty unprecedented times when it comes to the stimulus packages that are available. So we really don't know what effect that will have come September. One thing that I do know will affect the property market, and I don't know how much by, is immigration. We've been very lucky in the last 27 years in Australia to have economic prosperity. And a lot of that's based on immigration. When you've got immigration, you've got families who come from overseas who come and live in Australia. When they come in and live in Australia, they obviously need housing. It's a staple of their life. So that helps our whole property market increase and grow. So immigration will slow down. That will have an effect on our property market at some stage. And in fact, it's stopped at the moment because it's not letting people in from overseas and our borders are officially shut. As I said, the stimulus package is to counteract that, and I think it's doing a really good job in the property market. And the low interest rates, I mean, seriously, what Tyson spoke about before, interest rates in a 2% range is just really unheard of. So capital is so cheap, and as I presume a lot of your property investors, because we mainly marketed it to our Coronis clients and our landlords, your yields on your properties are going really well. As Jody spoke about, rents really haven't dropped for us in Southeast Queensland, especially in our portfolio of nearly 8,000 properties. So we have a pretty good market from the Sunshine Coast right through to the Gold Coast, yeah, which is really important. So your yields on your properties, it was only a year or two ago, you were paying 4 or 5%. It was only 4 or 5 years ago that were up at about 7 or 8%. So the yields on your property are a lot better. And a lot of people, especially investors, have to start understanding it's actually a pretty good investment class at the moment, which is really important. I will give you some stats on buyer inquiry though. In February, we had 6,613 buyer inquiries. And in May, we had 9,503, which is nearly a 50% uplift in the middle of COVID. Now, why was that? Was it because people were at home and they were bored and they had nothing else to do but go on and inquire about property? I don't think so. I think we've had a pent-up demand for buyer inquiry for a long period of time, and there's a lot of buyers very active in the market because at the same time, as Trent talked about, the listing production for our business anyway dropped by nearly about 50% as well. So you had this incredible spike in buyer demand and you had this incredible level or dropping of stock available on the market, which creates the one thing I believe that buyers of property have, which is FOMO. We're all humans, and when we start missing out on things and we're seeing things sell, so it's created a reasonably strong sales activity. Our sales numbers are low, not because the days on market are blowing out or it's hard to sell property. It's more because there's just not enough stock on the market, because I presume through COVID, most people sat at home and said, I'm not going to move, I'm going to see what happens. So I can really give you some confidence, I suppose, to say if you are thinking of selling, we actually know now houses are transacting relatively quickly and relatively seamlessly. We don't know what's going to happen in September. There was a question that came through from Matthew about with the lack of stimulus in the thank you for your question, Matthew, a lack of stimulus in September with immigration stopping and with people not having any jobs, is that going to create a lot of people who need to sell? My answer to that is probably. There'll be a lot more stock that comes on the market in September, which means when, again, that equilibrium supply-demand gets changed, if more stock comes on the market, it's going to put a lowering pressure on houses. We saw all the banks come out and say some, in my opinion, outlandish numbers of where they thought it could go to. And I'm not even going to repeat the high numbers. I don't think it's necessary. But I'm more, again, this is my opinion, I'm more of the feeling that there is going to be a small drop in property prices come September. I don't think it'll be 10+%. I think we have what we call a false floor in the market, that people get to a certain level and they just don't sell. I mean, it's not like the stock market where you can trade them every day. Selling a house is something, unless you are forced, like we're talking about with job losses, to sell your house. Most people will just stay in their house or keep their investment property. So it halts supply to the market, which then halts the market going into free fall, unlike the share market, for example. So, Matthew, to answer your question, do you think there'll be pain come September? I think was a question in the word pain. I think there will be some pain come September. I think that's normal with the lack of immigration, if the stimulus comes off and if people lose their jobs. I think that's a logical argument to run, and that's my opinion about that. Pardon me. Interestingly, that the unemployment will be the biggest issue. When people have got a house, people have got a job, they love buying a house. And at the moment, to be quite honest, I think we are probably going to have a situation where rents are going to be under pressure, because in most cases around southeast Queensland, it's cheaper to buy a house in the areas we work in. It's cheaper to buy a house than it is to rent a house. I heard of a property at Bracken Ridge yesterday, and it's a townhouse at Bracken Ridge, a great suburb on the north side of Brisbane, close to all the amenities with the gateway going past the north coast and the south coast and the CBD. It's a schools, it's got everything going for it. And the property was being rented for $380 a week, and you could buy it for $280,000. And I thought to myself, what a wonderful, wonderful opportunity for an investor or a first home buyer to get in and have something that's just about positively geared once you take in the interest rates of the property. So the answer, to your question is, what's going to happen to my property price? I wish I didn't know. I do know that I believe there will be downward pressure on it. What that level will be, I don't know. That could be 5%, it could be 10%. I don't think it'll be 30% like some of the banks said. I think that was a bit of them protecting themselves just in case things went bad. But I also do know, interestingly enough, the banks, because the interest rate is so low at the moment, this is back to your question, Matthew, with the interest rate so low, the banks can work with people and their mortgages a lot longer instead of having to ship them out of their houses. And I know that for a fact that that's their intention in this. Instead of back in the recession we had in 1990, some of you might not have even been alive back in 1990, but I was 20 years old back in 1990, and I remember that it got really tough. And I remember the fact that it was there were mortgagee and possession sales everywhere because banks were actually moving people out of houses. But we had 10% plus interest rates now. Now we've got 2%, which is effectively only $2,000 per $100,000 borrowed, if you can get that rate. And it generally means that the banks will work with the consumers more. So that's my take on it. There will be some downward pressure. I think rents will be reasonably solid. I'm really pleased to hear what Jody said about, and we're so excited about the vacancy factor and what our team is doing. I think it defies market trends. And even with Tyson, what he's talking about with the rebates that the banks are giving, seriously, do yourself a favour, and whether it's with us or with anybody else, have a look at the interest rate you're paying and compare it to what Tyson just showed you tonight. I think you'll be pleasantly surprised that you're probably paying too much, because banks don't come to you and say you're paying too much. It's up to you to figure that out. Yeah. And with that, I don't know if there's any more questions, Elaine. I just wanted to wish you well. I wanted to say to you, we've got it in control at Coronas. We're very confident in the market. We've restructured our business to a stage where we are doing, and our team, I'm so proud of our team, working through hard, long hours to make sure our owners, make sure our sellers are being well serviced. I couldn't be more proud of the team and what they're doing, working 6 and sometimes 7 days a week to do the right thing by people. And as for myself as a managing director, I wish you well. I'm confident in the property market. It always bounces back, guys. It's a time thing at the moment. We don't know what is going to be thrown at us, and all we can do is control the controllables. So if you're thinking about selling, financing, or renting your property, give us a call and we'll talk you through it, and one of our specialists will. And if not, hold on and everything will be fine in the long run. Like my father used to say, it'll be all right in the end, and if it's not all right, we're just not at the end. Thanks, guys. Cheers.
Like